Good evening, I'm Mike Knetter, and welcome to the UW Now Livestream series, where we bring you experts from the UW community to talk about timely and important topics. Tonight, we're going to shift our focus back to the economy, and we're going to talk specifically about what's going on in the state of Wisconsin and what's going on in the national labor market. The recovery has been reasonably strong, considering the virus is still a concern for people. How far are we from full employment? And how much structural change will we see in the mix of jobs compared to what existed before the pandemic? And what are the most important additional policy actions we can take to get to a full recovery? Joining me tonight are two UW experts. Erica Groshen is a UW economics graduate and former commissioner of the U.S. Bureau of Labor Statistics and former vice president at the Federal Reserve Bank of New York. She's now senior economics advisor at the Cornell University School of Industrial and Labor Relations and research fellow at the Upjohn Institute for Employment Research. Noah Williams is the Juli Grainger Professor of Economics and Director of the Center for Research on the Wisconsin Economy. Thank you both for joining me tonight. It's great to have two people who look at the data so extensively the way the two of you do and share some of your insights with our audience tonight. So I don't know if Noah Williams won the toss, but we've elected that he's going to receive the kickoff tonight.
Home field advantage. Yeah.
There we go. So he'll be our first speaker. And as noted, he's the Juli Grainger Professor of Economics at UW Madison and the founding director of the Center for Research on the Wisconsin Economy, known as CROW. His research focuses on macroeconomics, particularly monetary policy, social insurance programs, and financial markets. Maybe we can ask you about GameStop, Noah. He has co-authored several papers with Nobel laureates Lars Peter Hansen and Thomas Sargent. He's also a member of the Economic Advisors Roundtable. His research on state economies, which underlies the work of CROW, has been supported by a grant from the National Science Foundation. Noah received his BA with honors and his PhD in economics from the University of Chicago, but I will note a Wisconsin native as well. So Noah, thanks for being here tonight. Take it away.
Okay, great. Glad to be back with you here on the UW Now live stream. So what I'm going to talk about today, I'm going to focus more on what's going on and what has gone on in the state economy. And then we'll expand out a little bit more and talk about what's gone on nationwide. There's a lot of very similar trends which have happened throughout the pandemic, both statewide and overall. And then I'm going to give a little bit of an outlook as to what do we expect going forward in the rest of 2021. At CROW, we recently ran our forecast for the year. So if you're interested in more detail on that, as well as our other work, you can find that at the website, which is listed there. But I'm going to just jump right in. And again, in the past, I've relayed some of this data, but it's worth first noting where we are and where we've been as we've come through the vast economic disruptions and changes which we've seen in the pandemic. So I think the most striking picture is just looking at initial unemployment claims. So these are people who are filing for unemployment for the very first time. And here, let me zoom in a little bit. What's shown there are initial unemployment claims nationwide, which is on the left scale in blue, and in Wisconsin, which is in red and on the right scale. And you can see they follow very much the same pattern. Initial unemployment claims at the beginning of 2020 were very low in the state. They were running about 6,000 people being laid off and filing for unemployment each week. In very short order, as we went into the pandemic, these unemployment claims spiked. In Wisconsin, we had a peak week of 111,000. And again, just to give some context, going into the pandemic, there were less than 100,000 people unemployed in the state. So the unemployment number of people unemployed basically doubled within a week. Unemployment claims remained high, but fell off rather dramatically and rather quickly. And even though they've come down substantially since the peak, they remain at an elevated level. I mean, the scale there, the peak is all you see, but if you look basically from September onwards, we've remained at a relatively high level of about 20,000 people filing per week, which is again roughly 3 times what it was a year ago. So much better than where we were, had substantial recovery, but still quite a ways from where we were in the pre-pandemic days. Similarly, if we look at unemployment rates, the headline official unemployment rate for the state is in red there, and you can see it follows a similar pattern with a little bit more slower recovery. Unemployment peaked at just under 14% in April of 2020 and has come down substantially, but has been basically flat since September. The most recent reading, which just came in the other day, for December was 5.5% unemployment in the state. In September was 5.4%. So we fluctuated right around the same constant level. So again, overall picture, very rapid increase, relatively rapid recovery, but we've stabilized at a substantially higher level than we went into the pandemic with. So according to different measures, we're somewhere between 1/2 and 2/3 of the way out of the hole that we dug during the pandemic. Also, what's shown there is the insured unemployment rate, which is just calculated as the percentage of people who are eligible for unemployment insurance, who file for unemployment insurance. And you can see that that's gone up, again, follows a roughly similar pattern, but has gone up a little bit in recent weeks. So there is some concern that the recovery has certainly slowed, and there's a possibility that things have gotten a little bit worse over the last month or so. Different measure of job loss. So that was the unemployment rate, which we measured the unemployment rate by asking households, doing a survey of households, finding out who's working and who's not, and those who are not working, who are searching for a job. Again, that's become a little bit more difficult in the pandemic since a lot of work search requirements have been waived. But nonetheless, if you look at the household survey, which is shown in the blue here, this is a measure of job loss, or the number of people who are employed in the household survey. And this is just looking at the change since January. Also, what's shown there in the red line is the payroll survey. And the payroll surveys, we ask firms how many workers are on their payroll. And this is a monthly measure and done with a sample of firms. And these numbers tend to track each other over long spans. They're out of, have some slight discrepancies occasionally, but this is a fairly substantial discrepancy here. And in particular, according to the household survey, now we're only down about 58,000 jobs since January, whereas with the payroll survey, it's more than double that. It's 214,000 down from where we were in January of 2020. So according to this measure, again, you can see substantial fall, relatively rapid recovery, but we've stabilized and we're only about 55% of the way back. So the economy is doing better. We have seen, substantial growth since the lockdown periods and the real heart of the recession in the summer. But things have really stabilized at a lower level over the last several months. And again, here you can see it's been stable since about September. So we'll get more into discussions of the labor market overall and different measures of the labor market. I just wanted to give a brief picture of what's gone on here in the state. Although we're focused mostly on the labor market today, I wanted to talk about a couple of other features, though, of the economy, which have done a little bit better. And in particular, one measure which has done better is consumption. So let me zoom in on this. So if we look at consumer spending, and we get similar data or similar results if we look at measures of retail spending. This is from a private company, Earnest Research, who reports consumer spending. It's basically, they have a relatively large sample. And this is weekly data coming from transactions on credit cards and debit cards in the state. There's 2 lines here, which are maybe a little bit difficult to see, but they generally move in tandem. But Wisconsin is the top one. So what we see in consumption is very different from the labor market. Consumption, which is in many ways what economists take to be one of the main measures of living standards and economic well-being. Consumption fell very rapidly during the lockdowns, but also recovered very quickly. And you can see, if we zoom in on the last few weeks, we've seen substantial growth in the holiday and post-holiday period. Wisconsin consumption spending is now up 10% year over year. So employment remains reduced. Employment remains down at a lower level, but consumption has recovered substantially. A lot of this is due to the fact that we've had substantial fiscal support, both through unemployment insurance and through the direct fiscal transfers, 2 rounds of which have happened now, and there's potential for a 3rd round, which has helped to support consumption across the income distribution. One measure, one way of thinking about some of the massive structural change we've seen, and how have we been able to have sustained consumption during a period like this of such a disruption? Well, there's been big changes in consumption. What's shown here are 2 lines, which is spending in-store versus online. Online is the top one, which is in green. And you can see, there's been a trend overall in recent years of shifting transactions from in-store towards online that accelerated during the pandemic and has remained high. In-store sales, again, this is in the state, have remained low. In-store sales are still down 5 to 10%, whereas online sales are up about 30%. So there's been a big shift, a big change in the composition of consumer spending, which also has implications for the makeup of businesses and business activity. And we can get more into that discussion later on. Finally, just want to give a brief outlook about what do we expect going forward. We've seen the rapid decline in activity, relatively rapid bounce back, but then things stabilizing at a lower level. Recently, we in Crow, jointly with my colleague Junji Guo, we did a forecast for the year based on the data which we have in hand and based on our usual forecasting model, which we've done before. There's, of course, more uncertainty these days than there has been in the past. A lot of the historical relationships have possibly broken down. So we take these forecasts with a little bit more of a grain of salt than usual. But nonetheless, we thought it was instructive to at least see what the model suggests would be the outlook for the next year. What's shown here is the employment for nationally, which is on the left, and Wisconsin, which is on the right. Again, they look relatively similar, but what do we see? We see a continued slower recovery. I do want to emphasize that these forecasts, again, based on historical data, are a lot more pessimistic than some of the forecasts which have come out of Wall Street and the big banks, which are expecting growth to be running 4 or 5% or more. Our projections are more in line of about 3%. So more similar to what we've seen coming out of a typical recession. Of course, this recession is atypical, so take that with a grain of salt. But nonetheless, we do see, again, continued recovery, unemployment rates, both with nationally and in the state, coming down, but not getting down to pre-pandemic levels by the end of the year. And similarly, we see GDP recovering roughly to pre-pandemic levels by the end of the year, or just off them. So not a whole lot of surprise in the forecast, but we do suggest, or they do suggest, a continuation of what we've seen, continued growth, but at a slower rate. Of course, we're hoping that the fiscal stimulus will perhaps support stronger recovery. The course of the virus will continue to improve. People will be vaccinated, and we'll see much stronger growth than that. But at least the data we've observed so far gives us some reason for caution. So that, again, was a very brief overview. I'll end there and pass it back to Mike, and we'll take up some more of these in discussion. Hello?
It might be depressed, Noah. So, okay. Next up, we have Erica Groshen, who is a senior economics advisor at Cornell University's School of Industrial and Labor Relations. and a research fellow at the Upjohn Institute for Employment Research. From 2013 to 2017, Erica served as the 14th commissioner of the U.S. Bureau of Labor Statistics, the principal federal agency responsible for measuring labor market activity, working conditions, and measuring inflation. Before that, she was vice president in the Research and Statistics Group of the Federal Reserve Bank of New York. Her research has centered on jobless recoveries, wage rigidity and dispersion, and the role of employers in the labor market. She earned her PhD in economics from Harvard after earning her undergraduate degrees in mathematics and economics from the University of Wisconsin. Erica, thanks for joining us tonight, and we look forward to hearing your outlook for the U.S. labor market.
Thanks, Mike, and thanks to Noah and the audience. It's great to be here talking to my fellow Badgers. So let's pull the slides up. I think I'm not running them, although I can if I need to, but let's pull the slides up and then I can take off. Slides, guys? We lost Chris and are pulling up the slides now. Okay, I'm hanging tight. All right, well, let me tell you generally what I'm going to be talking about. I'm going to review some of the dramatic headline numbers. I'm really going to be focusing on the U.S. as a whole, and focus on these headline numbers that we get every month, the first Friday of every month, the payroll, jobs changes, and the unemployment rate. So we'll review that, and you'll see similar things to what Noah showed you. Then I'll go beyond that and look at disruptions that we measure in other ways using additional data produced by the BLS. And that will help us, I think, look a little bit further at what we can expect going forward. So that's the general idea. And all right, let's see. So there should be, the slides should be coming up any minute. And so I'm going to run through my first few slides pretty quickly because that's what I've already told you. Here we go. All right, very good. So this is just my headline slide. The next one is the agenda slide. So I've already told you guys what we're going to do. And then the next slide says, okay, now we're going to look at those dramatic numbers. So let's look at the first one. So next slide. This is accounts of payroll jobs, and this compares all of the post-World War II recessions in terms of how many job losses there were as a percentage of the jobs before the recession, and then the pathway back to recovery. So what you can see from this is that the 2020, the COVID-19 recession had a much, much more abrupt entry and a very steep one compared to all of the post-World War II recessions. We are about a little more than halfway back, but you can also see that the past few months, the recovery has really stalled. Okay, so that's what payroll jobs are telling us. And this is a count of how many people are on the books in business establishments in the US. So that's an employer-based count. And looking at where the jobs were lost and regained, this slide, all the red bars are the losses in various industries from February to April. And then the blue bars are the gains from August to September. And these numbers are very highly correlated, negative correlation, obviously, but very close, it's about 0.96. So the jobs regained are pretty much in the same places as the jobs that have been lost so far. Okay, next slide. Here we're going to look at what happened to the unemployment rate. Now the blue line here shows you the monthly unemployment rate from January through December for the country as a whole. And you can see a huge increase in unemployment, particularly from March to April. I mean, actually the February to March one was pretty dramatic by historical standards here, but it doesn't even look like that because from March to April, it shot up so fast. Right? In 1 month, the unemployment rate went up by 10.3 percentage points. And the striking thing is it turns out that that was an underestimate. The BLS has been very transparent about the fact that a lot of people who are on temporary layoff didn't actually get counted as being on temporary layoff because they answered the questions in a way that slotted them into being treated as if they were on some kind of a leave from their employer rather than being unemployed for that time. And the dotted line is a maximum estimate of how many of those workers might have been misclassified. So if we counted all of that increase into the unemployment rate, then our unemployment rate actually would have been, would have been much closer to the levels that we saw during the Great Depression. It would have been up closer to 20%. And the Great Depression estimate is that the unemployment rate was about 25. Actually, that line, it was actually closer to 25%. Okay. Now you can see that the impact of the misclassification has declined, but it's not gone entirely. And so if you look in December, misclassifications mean that our unemployment rate may actually have ticked up in December and be above 7%. So you can see the tailing off here too. Now the next slide, our next slide shows that there is quite a disparate impact by race. In particular, non-white unemployment has risen much more than white unemployment. So the impact has been much more severe for particular African Americans and Hispanic workers. Interestingly enough, the Hispanic unemployment rate shot up much higher than the Black unemployment rate, which is typically not, although now it's gone down below the Black unemployment rate. Okay, so now jobs, unemployment isn't the only way a job can be disrupted. Another important, some other important ways that jobs can be disrupted is you might have a dramatic cut in your hours, either on a daily basis or number of days you're working per week, or how many weeks you're working in a month, that sort of thing. And you might have been forced to take some kind of leave, and you might have left the labor force altogether. So on the next slide, we take a look at a COVID-specific way of measuring job losses, these disruptions. And this will account for all of the ways that workers' jobs could be disrupted. The layoffs that we talked about before, the temporary layoffs and the permanent layoffs, but also these unofficial layoffs, the misclassified ones where you're without a job but you're not at work, shorter hours, and leaving the labor force. An important thing about counting all of these is to get some idea of how much deeper the impact is than the unemployment rate alone will tell you. And also to be able to divide these up by how many of them retain a connection between the employer and the employee, and in how many cases are the workers just cut loose, which is obviously a bigger long-term disruption. So the next slide shows you my estimate of all of these different kinds of disruptions, and by all the months since COVID hit. So the three bottom areas are all different shades of blue, and those are the three kinds of disruptions that retain a connection between the employer and the employee. So the darkest one are these misclassified workers, the employers, the people who are employed but not at work. The medium blue are the workers who are on temporary, who are working part-time for economic reasons, which is basically involuntary part-time work. So they would like to be working more hours than the employer can give them. And then the pale, very pale blue one are the workers who are on temporary layoff. They're on furloughs. You can see in April, the big increase was mostly people who are on temporary layoff or short hours or not at work. So well over 75% of the disruptions were in those areas. We had no increase in people who are unemployed, but not or unemployed permanently in April. But as the pandemic has gone on, we've had a larger increase in people who are unemployed permanently. And the people who've left the labor force, who are the two purple areas, they're the ones who where you've seen essentially no reduction in the impact of the pandemic. So a lot of people have left the labor force and have not started to come back yet. Okay, so the headline unemployment rate, which would only take account of the orange and the palest blue, understate the disruptions by about half, and the ties to employers are falling throughout this time. These employer-employee connections are one of the reasons we were able to recover so many of the jobs so quickly early on in this recession, because you have lower search costs, the workers are already trained and immediately productive, they have not so much anxiety because they're still connected to the employers. But now we're in a situation where fewer of those disruptions involve people who have a connection to the employer. And so we're entering a phase where the rapid recovery of jobs is going to be much harder. We're going to need investments. We're going to need new businesses and retraining to really get back to where we were before. So what does this mean looking forward on our next slide? Actually, this is, that's what I should have called for this slide before. This is what I was talking about before. So this is what I already said. So let's go on to the next slide. Looking forward, next slide. Let's see. Let's put this in the context of the typical recession. Typical recession, you get a shock and you get some job and revenue losses because of the shock. And then you enter this period of great uncertainty where, because there's uncertainty, you have restraint on the part of households and businesses and governments. And because they restrain their spending, it causes more uncertainty in the economy, which causes more restraint. And this is the typical downward spiral of the Keynesian recession, right? And you can see that this little general graph that I show there, we overall GDP trends upward, but we have these recessions around the trend, right? And so what breaks this downward spiral that I just described? Well, there are a number of things that can break that. And one is when you have consumption that's supported by relief, as we saw it was with the CARES Act and other steps that were taken. So the unemployment insurance and direct fiscal payments to households help to support consumption. And that helps slow this the contraction of the economy and helps to turn it around. But the other important thing to really turn the corner and break the downward spiral is investment on the part of the private sector, but particularly on the part of the public sector to gin up the economy again. So now let's go on to, if this is going to happen, the next slide, right? This is the one. Stay with this one. What are the sources of job growth that we need to have in order to get to our recovery? Well, there are four kinds of job growths. First are the recovery of jobs that we had before, right? So when the pandemic is over, right, then we're going to have a return of a number of jobs that have only disappeared because of the pandemic restrictions. So I'm in New York. Broadway will come back again, and there will be Broadway jobs again. And so those old jobs, maybe not all of them, but many of them will be recovered, right? And then there are the jobs that might be lost because of this recessionary dynamic where everybody loses confidence. And when confidence is restored, you're going to get some jobs that come back just because overall level of activity is higher. Right? Then there's another two kinds of jobs that will be part of our recovery. One will be the jobs that are new jobs because of continuation of trends that were already in place before the pandemic. So jobs being created due to automation, globalization, climate change, demographics. As the economy changes, we create new jobs in those areas, right? And then there are also going to be new jobs that are created, and I should say, some of them are replacing jobs destroyed, right? That are because of the long run impacts of the pandemic. And we can, there are many lists of what these might be. No one's certain, but you can imagine that there are jobs associated with remote work and transaction impacts on travel, education, etc. There will also be jobs associated with reorganizing supply chains, those associated with improving communal safety of communal living, and jobs that will support the infrastructure that we all need to keep improving so that we can have a good rebound. So these are the four sources of job growth that we want to see coming back with during the recovery. So the next slide so what is this going to look like? Well, if we focus on what the number of payroll jobs is going to be, you already Noah showed you a graph that looked a lot like this. This is called the swoosh scenario. And most people are thinking about the rebound having the recovery looking something like this, that we've already had the big decline. We've had a very rapid early recovery, and now we're in the long, slow slog, right? So the outlook that most people have for 2021 is the shutdown effects moderate. There's not much discussion of whether or not a recession will take hold. I think that's something we do need to worry about. Within this, we can expect to see a lot of churn, jobs being destroyed, other jobs being replacing them. And so if we follow a trend very much like the last three recessions, we're going to have a long slog before we get back to the trend that we had before, 5 to maybe 8 years. The fastest part of the recovery is likely over. And here's where policy can help. It can speed the recovery as long as the virus is under control, or shall I say when the virus is under control. Let me push ahead now to next slide. One important element in all of this, and we can talk more about fiscal policy going forward, but I want to talk about one part of it that's often ignored. And this is very important to me from my time at BLS, but also as a big user and of statistics. So let's talk about the need for statistics. Why do I highlight this? Next slide. Well, because without the statistics, we're all flying blind, right? The COVID-19, this experience we just went through, shows us how important statistics are. Because for those of us who love data, we sometimes forget why it is we love data. And the answer is very simple. We love data because it allows us to make better decisions than we could without it. And it's very simple, all right? And this a time of stress is a time, part of what's stressful is you have to make decisions, right? And so COVID has made the challenges for official statistics very starkly apparent. To better inform our decisions and to target policy, we need more granularity in the data, which geographic, demographic. We need more timeliness and frequency. We'd like to know not just monthly, but weekly, daily, how things are going. We'd like to have more consistency across products so that we can combine different kinds of products and look at things in new ways. We need to be able to ask new questions because COVID-19 all of a sudden got us very focused on questions we hadn't ever thought to ask before, right? And the next crisis of whatever it is will also bring along some new questions. These days, we've also learned how important it is to be sure that our statistical agencies are independent from political influence so that we can really trust their answers. And of course, in these days, it's very important to protect privacy. So to come out of this recession well, one of the things we need is our businesses and our leaders and our policymakers of all kinds need to have good information so that our discussions are grounded in facts we can all trust. And you, next slide, can help improve official statistics. One thing you need to do always is to decry any political interference that you see, and I'm happy to answer questions about whether there was any at BLS. I'm quite confident that there wasn't any, but you can imagine how difficult it would have been had there been. This independence is necessary for people to trust and use the statistics, right? The other important thing you have to do is not free ride. You need to speak up for evidence and official statistics, and this involves a lot of things. First of all, when people trash official statistics, you need to tell them that they don't know what they're talking about, right? And if you don't understand how to defend those statistics, then I'm happy to tell you all the different steps that the statistical agencies and BLS in particular takes to ensure the trustworthiness of the statistics. And if you use official statistics in any way, you should always be citing the sources so people understand where the information comes from, and the agencies get credit for doing this work. You should participate in federal surveys because they're so important for all decision making. When you don't participate, everybody else's decisions in the country are going to be a bit worse off. And you should be encouraging everybody in your family, in your businesses to participate. And then finally, you need to support the funding and restructuring of the statistical system so it can continue to modernize. And here's some ways to join the Friends of BLS. You can do it on the web, you can do it via LinkedIn, you can do it on Twitter. So I hope all of you will do that. Next slide. So let me wrap up by talking about our economic recovery. We had a very abrupt, deep shock by historical standards. We're about halfway back, but the headline statistics understate the impact on workers by about half or more. The jobs recovery has slowed markedly in the past few months. The share of disrupted workers who are tied to employers started off very high, and now it's much lower. And that dims prospects for further rapid recovery. Hispanic and African-American women, African-Americans and women's workers, I didn't show you the women, workers' jobs were more disrupted. We can talk about women if you're interested. So I would say that the prospects for further rapid recovery depend on three very important things. The pandemic, we cannot recover until the pandemic is over, right? Secondly, fiscal relief and stimulus. Without it, we cannot recover quickly. And third, official statistics to guide decisions at all levels. And now I'll be happy to join everyone else and discuss whatever questions you have. Thank you.
Terrific. Well, we do try to attract the nerdy element of the alumni population, but we've never asked them to be friends of BLS. I love that. I love that.
So, it'll make you feel good, and it's free.
I thought we were competing for fundraising here. No.
No?
BLS is a fantastic organization. I had my own brush with it when I worked at the Council of Economic Advisors. But Erica, I want to ask you, I hear people occasionally on both sides of this issue of inflation, convinced. Typically, I'll hear people say, well, they're understating inflation so that the index payments to Social Security recipients don't go up as fast. And, so there may be a conflict of interest potentially, right, for the federal government to understate it. Tell me, as a commissioner at BLS, I mean, that's got to be one of the biggest projects you all work on. And I know a lot about how hard you work to control for new products and new distribution, but maybe you could tell our viewers a little bit about what all goes into that measurement issue.
Sure. Before I get into that, let me just tell people a little bit about BLS. There is only one person at the BLS who is a presidential appointee. Everybody else is a career employee, right? So the only person who's a presidential appointee is the commissioner, and the commissioner is appointed for a fixed term, cannot be fired by the president because the president doesn't like what the person is doing, right? Within the realm of presidential appointments, there's a big distinction made between those who serve at the pleasure of the president and those who are there for technical jobs. And the commissioner is one of those. There are a number of very important processes and procedures that are followed by the agencies to keep them separate from any political influence. So, and OMB oversees all of those. So the agencies are intended to be protected, and certainly when I was there, there was no attempt to influence the BLS, and I have been in touch with people since then, and I'm sure that I would have heard had there had been any influence. So how is inflation measured? You need two things to measure inflation. First of all, you need to monitor changes in prices. So you get a whole bunch of price changes, and then you take an average of all of those price changes using what's called a market basket. So if you know that gas went up by this amount and price of cars went up by this amount and rents went up by this amount, you have to have a market basket to average all of those price changes together to get an average change in the cost of living. So BLS is out there all the time, every month, collecting on the same goods that they priced the month before. And so the core of the price changes is the core of the strategy is the same goods repricing. And so they try as much as possible to price the exact same shirt, the exact same kind of gasoline, etc. And there's one of the big challenges is when products change in quality. How do you adjust quality? And then the other challenge is, do you have the right market basket? Because you're talking about an average price change, in particular and an average cost of living change, any particular individual is probably not going to have that exact same change in their cost of living, because no person probably has exactly the average market basket. So one person could have a much higher rate of inflation than somebody else, but that doesn't mean that the average number is incorrect.
Great. Well, my experience is, they put a lot of work into some of the really nuanced technical issues as well when there are changes in product quality and the way they decompose products using hedonics. And I think if most people understood how seriously that is taken, they would feel great about what these agencies do. So thank you for your service there.
Oh, you're welcome. I do recommend that anybody who wants to understand how these things are done, read the BLS's Handbook of Methods. Also, the best cure I know of for insomnia.
I'm glad you added that so I didn't have to. Noah, could you tell us a bit about how Wisconsin is doing relative to some of the other states in terms of the depth of recession and maybe our recovery? Are we holding up fairly well? And are there any big sector mismatches where we're still really struggling? Any thoughts on that?
Yeah, actually, so during the initial stage of the shutdowns, essentially, Wisconsin did a little bit better than the nation as a whole and other states. The recession and the job losses were largely concentrated in the leisure and hospitality industry. So restaurants, hotels, basically anything associated with travel really suffered. We have a lot of that, particularly in certain locations in the state, but it isn't one of our main driving sources. So in particular, if we look, so here's Wisconsin employment by sector. Total employment, we're still down about 7%, but leisure and hospitality is down about 28%. All right, so basically, on the other hand, manufacturing has recovered more strongly. That's the blue line at the top. Manufacturing employment is only down about 2%. So Wisconsin is roughly twice as manufacturing heavy as the nation as a whole. Manufacturing has done relatively well throughout the pandemic. Most manufacturers in the state, I heard some people, Buckley Brinkman actually said that if manufacturers were at all creative, they were able to be declared essential, so they were able to keep operating. So manufacturing employment didn't fall off as much. And again, this was largely a services recession. We've seen continued growth in goods. Since we're more of a goods-heavy sector, we did relatively well. But during the recovery period, we've actually lagged a little bit. So going into the recession, here's looking at unemployment rates by state. And this here, basically, the darker is worse or higher unemployment rate. At the start of 2020, Wisconsin was one of the 10 lowest unemployment rates. We're now about average. We're now, I think, 24th among states at 5.5%. So coming out of the lockdown and the recovery, we didn't do quite so badly, but we've tailed off a little bit since then, and some other states have done a little bit better. Focusing more on payroll job loss, which is this picture. Let me zoom in on that. Here's kind of the reverse. Darker is better. So the lighter states have seen a greater percentage of job loss, and you can see the regional concentration there. It's the Northeast, the West Coast, California in particular, and then the upper Midwest, Michigan and Minnesota have both done worse than us, but we're still down about 7%, which is on the high side relative to other states. The sort of broad middle of the country, the Great Plains, and then the South have generally recovered more. So we've gone from, overall, what does that mean? We've gone from being, one of the strongest labor markets in the country to somewhere more now in the middle of the pack, which means, relatively speaking, we've suffered some during this recession.
But not so much right out of the gate. And that's an interesting point because, in secular terms, manufacturing has probably been under more pressure in terms of jobs than many other sectors. Partly due to its productivity growth, but I guess in the COVID recession, it was good to be heavy manufacturing state.
Yes, yeah, a lot. Again, as we've seen, people shifting. We talked about shifts in the consumption basket. People shifting from consuming services or going on vacations to purchasing things for the home and purchasing goods. So goods production and goods employment has done better.
So great audience question here. What impact will government assistance, and we talked about its importance to the recovery, but what impact might that assistance have on the incentive for workers to rejoin the labor force and maybe search really hard? I could either call on a Chicago economist or a former BLS commissioner.
Erica, you can go first on that one.
Okay. The research on this is really quite clear that in circumstances like this, when you have a decline of jobs like this that we're talking about, the reason people are staying home is not because they have no incentive to return, right? This is there's actually, let me start off by saying that in the beginning, we didn't want people to return to work. We needed them to stay home. That was the whole purpose. We needed the recession, the pandemic hit, and we needed people to stay home. We put the economy into a medically induced coma, and we needed to keep the patient alive until we were ready to wake it up, right? And we are still in a lighter coma, but still a partial coma. So we need this relief in order to that our patient doesn't die while we're waiting for it to wake up, right? And then we will need the stimulus to actually wake us up when we're ready to wake up. So we wouldn't want a lot of investment infrastructure spending right now, right? But so right now, there is no reason, there's no evidence, there's no reason to think that what we have is a lot of people staying home because they are living so high off the hog, right? We have, our programs have reduced, have kept many signs of financial distress from increasing the way that they have typically during a recession. And that, I think, will help us to recover better. So I would say my reading of the evidence so far is that our problem is not that we have a lot of people staying home because of the incentives to stay home. We have people staying home because they need to be home. And what we need to do is be able to survive this period until it's time to recall them.
Noah, any thoughts?
Yeah, I guess I would take a slightly different tack on that. I mean, I think certainly during the initial lockdowns and recovery and reopening period, but I mean, as you mentioned already, we've seen more detachment of people from jobs. We've seen more longer term unemployment. That's exactly the type of time when we need people to be out searching for new jobs, finding new employers. And the continued expanded unemployment insurance, which still pay with now, it's not the $600 it was, but with $300 additional top-ups, we're still a number of people being paid more to be unemployed than they earned when they were working. Really, I think it dissuades job search. And again, most unemployment systems also waive the job search requirement still. So I think we need to not encourage people to wait around for a job which may not be coming back, but instead to search for a new job. And I don't think expanded benefits are the way to do that.
Well, let me ask, since Richard Kahn brought this up, how is raising the minimum wage to $15 going to impact recovery in employment? So suppose that were to go through, any thoughts on that? Probably, maybe we've already sort of answered that, but I don't know how people feel about that. I certainly hear a lot of people say, why would we do that at a national level? Because states can be so different in their local conditions. But Noah, do you have thoughts about that?
Yeah, I did see the proposal was put forth today where they were phasing in the $15 an hour over a very long span. I mean, there has been a wealth of research over the last, there's been a wealth of research on the minimum wage period, but there's been a lot over the last few years showing that the employment effects are maybe not as large as people had thought previously. Nonetheless, if we were to go to a federal $15 an hour minimum wage, which is more than doubling the minimum wage, at a national level, that's a far larger increase than we've seen before. Getting rid of the tipped minimum wage as well, which would affect restaurants, which are already in substantial distress. I I think the employment effects are maybe not as large as we may have once thought, but I also don't think it's, I think there's better and more targeted ways to achieve the same ends without these type of distortions, EITC being the main one.
Yeah, and so here's where we probably do have some differences. The real minimum wage, the real federal minimum wage, is much lower because it hasn't that it has been historically, all right, which is part of why it's been raised in a number of different states, and all of this, pretty much most of the the recent studies of these increases in the minimum wage have not detected substantial employment effects and have detected large improvements in earnings for people at the bottom of the distribution. So we have a much more unequal distribution of earnings now than we had before. It started widening in the 70s, and it's just gotten wider and wider and wider. So we have a huge amount of inequality that's being generated by these very low wages that are being paid, and they are let's see how do I put this. We only started to see some improvement of wages at the bottom at the very end of the expansion. All right. So real wages particularly for people without a college education have been flat to falling for 20 years. And it's only when you start to see some movements like this, like improvements to the minimum wage, that you see any sort of improvement in the terms of work. And that's part of what's going to draw people back into the labor market. So yes, we can all agree that if we made the minimum wage way too high, this would be a big problem for the labor market. I don't think anybody disputes that. But in the relevant ranges that we're looking now, this particularly with some of the distortions that we may have in the labor market due to monopsony and monopoly power, this is a policy tool to address that a little more directly.
Well, maybe we can come back in 2 years and we'll have data and we can answer that question. If the BLS, if we get enough friends of BLS tonight,
yes.
Who knows? Okay, question from Robert Baker. Will there be a permanent structural change from asset-heavy companies, so traditional factory and farm work, small-scale retail, to asset-light companies, online work, automation, companies with lots of economies of scale? Any thoughts on that, either of you?
Well, one thing I would say is that not all assets are tangible. So many of these companies that he's suggesting are asset-light have a lot of investment in their software and their business processes, in their brand and their business model. So these intangible assets are really growing in importance in the assets of companies. So it may be a switch from metal bending, from metal type assets to these more intangible ones. But I'm not sure that all in all, the assets, the total number of investment assets is that much smaller.
No, I mean, I think, more broadly, there certainly has been, an ongoing movement from small scale retail to larger retailers. We've seen that accelerate now with the online sales. We've seen increasing concentration across, as you'd mentioned as well, across a number of different industries. Whether that goes along with asset concentration, I'm not so sure, but certainly, there has been a long run trend away from bricks and mortar and building things to bits and bytes and intellectual property for sure.
So in discussing that minimum wage question, it was noted that, well, maybe these changes aren't that big, and so it wouldn't necessarily have deleterious effects, so that the changes are within a range where we don't see any of the maybe potentially adverse side effects of a big hike. At what point do we start applying some of that same logic to, let's say, federal debt or the amount of assets on the Fed's balance sheet? Erica used to work at the New York Fed. So, if quantitative easing has been a good thing and worked well, why don't we do it all the time? And if, federal spending on all these programs is helpful to the economy, why don't we do it all the time? I guess obviously some people think there are limits to that. And I also think people are changing their sense of when we hit those nasty spots where the limits become too constraining and trigger some adverse consequences. Any thoughts about how far we can push federal debt to GDP or how big the Fed's balance sheet could become?
So I can't give you a number, but I think let's go back to my medical analogy, right? We have a sick economy, right? There is an analogy to when a person is sick, right? We have this. It turns out it's a pandemic, so it is a medical problem. But we have this problem, right? And the medicine that you take when you have an illness is not necessarily something you want to take when you are well, right? So if you, if you're a diabetic, then of course that's a permanent condition. But if you had an episode of diabetes, right, you would take insulin then. But a healthy person should not take insulin. That would be bad for them, right? So during a recession, there are steps that you need to take to get your economy back to where it should be, so that you will be functional enough to grow well beyond it, right? And deficit spending in a Keynesian recession is something you should do, because otherwise you will be stuck in this downward spiral much longer than you need to be. You don't want to do it when your economy is doing well, right? That's the time to generate a surplus and pay down some of the debt. But you do want to spend on things that will make you stronger going forward, so that it will be easier to recover from these bad times, and also when borrowing is cheap. So this is the time to invest in schools and bridges and statistics and the things that we should be investing in, so that we are productive going forward. The question about quantitative easing, the interesting thing is that the success that the Federal Reserve has had in keeping inflation rates low for a sustained period of time meant that it has run into the zero bound problem, where it can't higher then interest rates would have been much higher, and the Fed would have much more scope for lowering interest rates. But because interest rates were low, then in order to get monetary policy back to a sufficiently stimulative stance, then quantitative easing has been the way to go. And again, it's rather like what I've been arguing with the fiscal stimulus. It's what you do when the economy needs this help, but not something that you need to do, and not something you would want to do when the economy was fully recovered and chugging along, basically.
Well, of course, we don't have a great history of running those surpluses in the recoveries, but Noah, do you want to offer any perspective on whether we're getting to points where we should be concerned about either the debt to GDP or the assets on the Fed's balance sheet?
I think we should. start to be concerned. Jerome Powell said we shouldn't even think about raising the Fed funds rate. So I'm not concerned yet, but I think it's on the horizon. I mean, typically in the past, 100% debt to GDP ratios were seen as a threshold. We're beyond that now and projected to go far beyond that. We're still in a deep, what I would argue, deep recession, and now is not the time to be worrying about shorter run things, but we do have some long run fiscal problems that we do need to start thinking about with the entitlements and the coming or increasing rate of retirements. So we've got to still have this big demographic issue out there and entitlement programs, and we need to think about long-run fiscal balances. That said, we do seem to have a lot more fiscal space than I would have thought a few years ago, for sure. That's always comforting to say. I mean, Greece thought they had a lot of space for a long time until they didn't. So I'm concerned about it, but again, we're just. Markets don't seem concerned. Interest rates, the cost of borrowing remain very low. There's very little pressure on the Fed balance sheet. There's a lot of demand for U.S. assets. We look around the world, and one of the things we have going for us is our fiscal books may not be in great shape, but look at Europe, and they're probably in worse situation. So it's something I'm concerned about, but it's not a current worry, I guess.
Makes sense. I guess it takes a currency to beat a currency. So right now we're in pretty good shape. Well, we have gone past the top of the hour. I want to thank you both for joining us tonight. Very interesting to hear your perspectives and on some important issues of the day. Thanks for making the time for us.
Thank you.
Thank you. Our pleasure.
So with that, I want to wrap up. Thank you for joining us again this evening. If you haven't already, make sure you subscribe to our Wisconsin Alumni Association YouTube channel so you can easily find and watch future episodes or go back and look at prior episodes. We'll be back again next Tuesday, February 2nd, with a special Founders Day edition to celebrate the first day of class at the University of Wisconsin, which occurred on February 5th, 1849. So that's a great thing to commemorate. I look forward to being with you next Tuesday. And in the meantime, thanks for tuning in and on Wisconsin.